Now on to a major result. HCL Tech came out with its Q1 numbers today, and another major announcement. We had Chandra, Srikanth catch up with the management of HCL Tech and asked about the recent change in the board, where Roshni Nadar Malhotra has been nominated as chairperson of the board, succeeding Shiv Nadar, who had decided to step down. Let's listen in.
The board has nominated Roshni Nadar Malhotra as the chairperson of the board, and Shiv Nadar, who's been the chairman so far, has decided to step down. He will continue to play the role of managing director and chief strategy officer. So that's the change, and I think it's broadly in line with the overall succession planning.
Right. And take us through your numbers for the first quarter. And, the last time we spoke, you said you're not going to give, you will only resume guidance when there's more certainty. How are things looking now? Just take us through the headline numbers for the first quarter, sir.
Yes. So, Chandra, overall, the outlook remains quite positive. And as I said, we started the year amidst this whole health crisis. So we expected a decline in revenues. So our revenue quarter on quarter declined 7.2% on a constant currency basis. It increased about 1% on a year-on-year basis in constant currency. But we had a pretty good operating performance. Our operating margin stands at 20.5%, which is about 340 basis points higher than the same period last year. We've had some very good bookings. We won 11 transformational deals. Even in this environment, our sales teams have delivered a fantastic performance in terms of net new bookings with a number of clients. So that has given us confidence to give a much better and sharper outlook for the next 3 quarters. As you would see, we've given guidance. We will grow 1.5 to 2.5% quarter on quarter on a constant currency basis for the next 3 quarters. And our operating profits, our EBIT will be expected to be between 19.5 and 20.5 for the full year fiscal 21. This is also pretty much in line with our normal guidance, normal operating margin range. So outlook is good. We have a little more certainty because of the bookings that we've done and the pipeline that we see, which is in advanced stage. All of that is making it a little more clearer. So the worst is behind us. We expect to see a good growth trajectory from here.
Right. Before I move to Mr. Agarwal, a quick follow-up there, Mr. Vijay Kumar. Clearly, the fact that you have decided to give an FY21 guidance in terms of revenue operating margin means that there is some visibility that's coming back. But when I spoke to you the last time around, you did mention pressure on discretionary spend. You also mentioned uncertainties on the demand side, supply side. Are things looking better now? Because many of these geographies are still going through a churn. There are instances of virus recurring. So what is giving you the confidence in terms of the pipeline ahead?
Yeah, sure. So, Chandra, there are 2 major trends that we are seeing, which is not a surprise. One is around cost optimization and vendor consolidation as a trend. The second one is a lot of digital initiatives are getting accelerated. Things like hybrid cloud adoption and application modernization, adaptive security, and many such trends and digital workplace, all of this is getting accelerated. And we have very strong infrastructure capabilities. We are one of the best in the world in terms of infrastructure, which is now the digital foundation capability that we have. So this actually gives a lot of impetus to what the customers are looking at this point in time, whether it is secure infrastructure, hybrid cloud, and automation, scale digital transformation, all of that. These propositions that we have been cultivating and investing in the last several years is become much more relevant than ever before for our customers. And that is reflected in the pipeline. Our pipeline at the end of 30th June was 40% higher than the pipeline that we had at the end of March. And this is a very, very strong signal that there is good momentum in the two areas that I talked about, cost optimization, vendor consolidation, and all the digital transformation initiatives. So we are encouraged by that. And of course, we've had very good bookings in the last quarter, which is pretty much similar to what we had in the same quarter in the previous year. All of this is giving us the confidence for a good outlook from now on, Chandra.
Is there a number you can share in terms of the deal wins or the potential deal wins? You mentioned that it's gone up by a significant percentage. The pipeline is higher by 40%. Any number that you can share there, sir?
Yeah, Chandra, we don't give the TCV wins. In fact, we make it easier for everyone to by giving the specific guidance on the revenue numbers. So because deal wins has so many dynamics, it's the net new, our net new wins have been very good. But then there is renewals, there is some reductions and projects getting over. So it's better to translate all of them into ultimately it's revenue which really matters. And that's how we've given a much more clearer guidance on revenue for the next 3 quarters.
Right. In fact, I remember the last time we spoke, you mentioned that renewals are actually tracking quite well. Mr. Agarwal, let me come to you. The EBIT margin we were factoring in, according to analyst estimates, was 19.3%, but the actual number has come in at 20.5%. So you've managed to expand margins despite a revenue decline. And this is a trend that we have seen among other IT companies as well. They have focused on reducing cost, travel costs have come down, Forex has also helped some players. What are the levers that have helped you, and will this be sustainable in the coming quarter as well, since you've given a margin guidance for the rest of the 3 quarters?
Yeah, thanks, Chandra. I think the numbers I would like to reiterate, EBITDA is at 25.6%. That is an increase of 490 basis points on a year-on-year basis. And EBIT is at 20.5%, which is an increase of 344 basis points year-on-year. So absolutely, those numbers are extremely good numbers, especially given the backdrop of this quarter. Unprecedented quarter by all yardsticks. What has given us this is largely, if I was to point to one factor, it's operational efficiency. The way we got down to managing the business, first for the benefit of our customers and our employees, and then of course for our other stakeholders, shareholders, and everybody else who's a stakeholder in the company. Trying to get our costs down as soon as we could, starting from the very beginning of the quarter. That has really delivered these kind of margins. And you're right, the expectations were pretty low, though in the kind of range that we are talking about, 19.5 to 20.5. But we managed to come in at the top end of the range, driven by the early action that we took. Of course, there are other factors like Forex and all of that, but if I was to call out one factor, that's just operational execution. If I could add, the story doesn't really stop there. I would also draw your attention to the wonderful cash generation that has happened during the quarter. And that is at a level of $819 million of operating cash flow and $757 million of free cash flow post-capex. These are numbers, just to give you the context, in the whole financial year 20, we generated $1.48 billion, 1480. And in one quarter, this quarter, we have generated more than half of that, $757 million. And because of that free cash flow generation, we today have $1.33 billion of net cash on our books. And that is virtually the same as the cash we had on the books last quarter, about 1.36 billion. And this is, mind you, after paying off $812 million of the second and final tranche of the acquisition related payout that we had. So all in all, I think both on the margin front and the cash generation front, it's been a fantastic quarter.
Chandra, I also want to add that one more aspect for margin improvement is our improving.
Okay, that was an exclusive interaction with the management of HCL Technologies.